Welcome to Hamrick Berg's 2023 Economic and Investment Outlook. I'm Ross Bramwell. I'm a member of the investment department here at Hamrick Berg, and I'll be taking you through this year's presentation. I'll be joined once again by my colleague Ford Donahue as well. We're going to cover a wide range of economic and investment topics, but to start the presentation, I'm going to summarize the main points that we will be discussing today as we begin 2023. The good news is that we have passed peak inflation. However, it is still too high as we spent most of 2022 above the 7% mark, which we believe means the Fed still has work to do. As long as inflation remains a problem, the Fed believes there needs to be a sustained period of below trend growth to bring demand down to meet supply. This does make us cautious as we begin the new year. If you're watching economic headlines, there are many indicators that are broadly used to point to a recession. Many of those are flashing red, including the yield curve, housing, and global growth. We'll cover some of those to put them in context. If it weren't for jobs and consumer spending, we'd already be in a recession. However, the job market remains strong, adding jobs every month still. But the Fed wants to see some weakness in the job market. The Fed believes that is the way to lower demand in its battle against inflation. It wants to see job openings decline as a sign the economy is slowing. In order to avoid a recession, the Fed would need to get inflation down, still without unemployment rising significantly. History indicates that may be hard to do, but so far the job market remains strong, which is supporting consumer spending. We're now past peak inflation and pretty close to the end of the rate hiking cycle. However, the impact of rate hikes is still working its way through the economy. So what we are now watching closely is earnings growth, which is currently expected to be slightly positive for 2023. But we expect earnings growth estimates to decline as the economy slows. So after all that, where does that leave us with portfolio positioning? Given the elevated recession risk, we have positioned portfolios with an underweight position in both domestic and international equities, and an overweight exposure to high-quality short-term bonds given the shape of the yield curve. Here on the bottom right, we can see that inflation has declined for 5 consecutive months from its peak of 9.1% in June. This is welcome news and a relief, but we don't believe it will lead to a policy change for the Fed in the first half of 2023 because 7% is still too high for the Fed as it battles to get inflation back down to its target of just 2%. And although the top line monthly CPI number gets most of the headlines, such as a decline from 9.1 to 7.1% since the summer, the Fed right now is more focused on the underlying components of inflation and those that it considers sticky, meaning those areas that don't move as quickly or aren't as volatile as some components such as energy and car prices. In this chart, if we look at the bottom 4 categories of shelter, lodging, leisure, entertainment, food, and other services, we actually see that we have not seen a peak yet as we follow the trend line. The decline from 9.1 to 7.1% has been largely from energy and car prices. The Fed is going to stay aggressive and raise rates until it sees a similar decline in these core components. There have been several contributing factors to the inflation we're dealing with, including supply chain issues, but it's hard to argue that a main contributor was not the unprecedented flow of money from the Fed and Congress to support the economy. Here the chart shows the historic increase in money supply from the beginning of 2020 through early 2021. The supply growth has significantly decreased over the last 18 months. You can now see it's below pre-pandemic normals or trends, which will help the Fed battle inflation, but it's also a sign of a slowing economy. Historically, the Fed funds rate, the red bars, has been raised to a level above CPI or inflation, the gray bars in this chart, in order to combat inflation and bring it down. Currently, the markets believe that the Fed funds rate will get to about 5%. So either inflation needs to trend down quicker before the Fed will pause, or the Fed may need to continue to hike rates into 2023. We're still looking for the current relationship to reverse before the Fed will pause. Here we have the chart of the S&P 500 for 2022. I really just want you to focus on the areas where markets had a bounce or short-term rally. We can see one in late March, and then there's another brief one in June, and then we had a longer one, July going into August, late in the summer. And then the final one of the year was November, kind of after the election, going into the beginning of December. Stocks were driven this year by expectations of the Fed's response to inflation. Stock bounces and upward trends were usually driven by an expectation that the Fed would slow down on the pace of rate hikes. And then down markets occurred when markets were surprised by a more aggressive Fed. Typically, this was driven by a hotter than expected inflation report, such as in June and September. And we'll also focus on this in the next chart. Here we have the market expectations for the year-end 2022 Fed funds rate beginning, though, in June of 2021. So this is showing across the last 18 months where people believe that the Fed funds rate would be as of December 31st, 2022. You can see for most of the second half of 2021, no one expected the Fed to raise rates in 2022. It wasn't until December of 2021 that the Fed had projected that it would hike 1 to 2 times in 2022. But that quickly changed in January through March. We can see expectations are rising. That's when we had our first correction earlier in the year. As expectations softened in March, the stock market then rallied. This relationship continued through 2022. It was in July that we had received June's peak inflation number, which shot up expectations once again. And then in September, when we got a hotter than expected inflation number and expectations rose again, stocks then sold off. As I mentioned, we are likely 80% or so through the rate hike cycle. Going into 2023, rate expectations have stabilized, which have helped stocks rise since the market lows in October. How the Fed sets expectations is very important and will continue to be closely watched in 2023. When the market and the Fed are aligned with what they expect, stocks can rally. However, going into 2023, the markets are already pricing in rate cuts in the second half of 2023. That's shown by the decreasing red bars of where they think the Fed funds rate will be going through 2023. This gives us a little concern because this is not what Fed Chairman Powell and other Fed members have communicated since the last meeting. They expect rates to stay higher for longer in order to see inflation come down closer to the target. Either the Fed or the market will currently have to change course. If the Fed's actions line up with its messaging, then it could cause the market to stumble this year, since the market would have to price in higher rates for longer. If you've been reading any financial news over the winter, you've probably seen headlines discussing the inverted yield curve. First, a yield curve is a line showing the yield of each maturity across time periods. Here we are showing the 3-month Treasury on the left to the 30-year Treasury on the right. For instance, the green line, the one here on the bottom, is showing the yield curve at the end of 2021. As you would expect, the yield curve is lower at 3-month than at the 30-year Treasury. Typically, a yield curve rises as you go further out in time. But as we move up this chart, it shows that the yield curve from June 30th, from September 30th, and early December, the line in red, the line is getting flatter each time. And with the current yield curve and shorter term rates that are actually higher than longer term maturities. In fact, the 1-year Treasury is the highest point on the curve. This is an inverted yield curve and typically indicates that the economy will slow down in the future. That's the expectation. The inverted yield curve means that cash and short-term bond products are generating higher yields than longer-term bonds. This is one reason why we have maintained a portfolio of bonds closer to the shorter end and taking on less duration and interest rate risk. We are not getting paid by a higher yield to go out further on the yield curve with longer dated bonds. The inverted yield curve makes the headlines because it is seen as a fairly good indicator of recessions. This chart shows that prior to previous recessions, the yield curve has inverted. Here we are showing two different spreads. We're showing the 3-month and 10-year Treasury yields, and then also in yellow, the 2-year and 10-year spread. The inversion occurs when this trend line goes below 0, and in the gray bars, we are showing prior recessions. As I mentioned, the yield curve typically inverts when economic growth is projected to slow down, as it is right now. I will note that recessions have occurred across a range of time frames, though, after an inversion, from anywhere from 6 months to over 2 years. So it doesn't tell us when the recessions may start, but the current yield curve inversion is at one of the deepest levels in the last 40 years. However, there are some bright spots in the economy, and the jobs market continues to be the main support for the U.S. economy and consumers. But this bright spot is putting the Fed in a tricky position because the Fed is trying to lower inflation. And since it can't control the supply of goods or workers directly, it is trying to lower demand to meet the supply. The Fed is using employment as the measuring stick. As long as the job market stays strong, the Fed believes it has more work to do. The Fed wants to bring these job openings, which are still at elevated levels, back down to pre-pandemic levels. If the Fed had a magic wand, it would magically make inflation come down to its target without unemployment rising to recessionary levels. But we know there is no magic wand. And as we move into 2023, it may become increasingly more difficult for the Fed to achieve that goal. Since jobs will be a key driver for the Fed this year, we're going to focus on it for the next few slides. The chart on the left shows that we are still adding jobs on a monthly basis. It would be hard to say that we are in a recession when we are still adding 250 to 300,000 jobs each month. Although hard to believe, the Fed wants to see these bars move lower to probably less than 100,000 new jobs per month to indicate a slowing economy. The chart on the right shows that weekly unemployment claims are on an upward trend as more companies are announcing layoffs. Although it may be hard to imagine, the Fed would see this as a good sign for inflation if it continues to trend higher, and that it believes it would make demand decline. This chart, though, may be the best measuring stick for the Fed: continued unemployment claims. This chart is going to show whether people who lose their jobs can find another job quickly, or if the job market is really slowing down. This would also mean less pressure on wages if people can't job hop, which is another crucial part of inflation for services. Remember, the Fed sees job weakness as demand weakness and that it's necessary to bring core inflation back down to its target. We saw a significant rise in continued claims late in the year, and we expect this will continue in early 2023 as companies continue to announce hiring freezes or additional layoffs. We hit an unemployment low at 3.5% this year, and we are currently sitting at 3.7%. The Fed in its December meeting projected unemployment at 4.6% by the end of 2023. Here's the headline, though, with that projection. Never has unemployment risen by 1% and the economy did not enter a recession. So the Fed has been very clear that it is willing to risk a recession to bring inflation down. And that's why we'll be closely watching the jobs picture in 2023.
Hello, and thank you for listening to the HB Annual Economic Update and Outlook. My name is Ford Donahue, and I work with Ross here on the investments team at HB. So far, Ross has walked through all of the developments in 2022 with inflation, the Fed, and the impact that they have had on the interest rate markets and the employment market here in the U.S. I'm going to spend some time walking through some of the economic indicators that we look at to give us a sense of the current state of the economy and markets. Then I'm going to spend some time talking about the earnings outlook and valuations in the equity markets, before handing it back to Ross for some final comments. First, let's look at the Coincident Economic Index, or CEI. This index is created by an organization called the Conference Board and looks at data points including payrolls, personal income, sales, and industrial production to attempt to provide a reading on the current state of the U.S. economy. As you can see on this chart, this line tends to trend higher in periods of economic expansion and then rolls over and declines almost immediately as a recession begins. In this chart, historical recessions in 2001, 2008, and 2020 are highlighted in gray, while red circles highlight the times during those same years that this coincident economic index has begun to trend downwards. Looking over to the far right, as we stand today, this index continues to push higher, driven by a strong labor market here in the U.S., suggesting that the economy is not yet in a recession. However, the leading economic index, or LEI, which attempts to give us an idea of where the economy is headed, does not tell as positive of a story. This index looks at several leading indicators such as consumer expectations, market conditions, and new orders to predict the direction of the U.S. economy. Historically, the LEI has entered a sustained downtrend between 6 and 12 months before the start of a recession. Similar to the last slide, historical recessions in 2001 and 2008 are highlighted in gray. Red circles highlight the periods when the LEI has begun to decline in advance of these recessions. As you can see, this index rolled over into negative territory early in 2022 and has been in contraction ever since. This is indicative of a heightened risk of recession as we head into 2023. On this slide, We're looking a little bit deeper into the underlying data points that make up both the leading economic index and the coincident economic index. On the right, we can see each of the underlying data points that are used to construct them both. Focusing on the leading economic data points at the top, you can see that there's a pretty balanced distribution, with some of these indicators at strong levels, some at fair levels, and some at weak levels. However, the trend in these data points suggests a generally negative direction for the economy as we head into 2023. We believe that the trend or direction of these indicators is far more telling than the current starting point. The Purchasing Managers Index, or PMI, is an index that gives us a sense for the direction of global economic trends in both manufacturing and services. A PMI reading above 50 suggests an economy is expanding, and a PMI reading below 50 suggests an economy is contracting. We like looking at PMIs because they are produced for each country and region across the globe, and thus they give us the ability to compare trends in economic activity across the globe on an apples-to-apples basis. On the left side of this chart, you can see several regions and countries, and with the top axis, you can see how PMIs have evolved over time. While there are a lot of numbers and colors on this chart, as you would expect, green means good and red means bad. On the far right of this chart, you can see that PMI levels are orange or red and below 50 for almost every country across the globe, with a few exceptions. We believe that this suggests that the risk of a global recession is high as we head into 2023. We would argue that the economic outlook in most major international markets, including Europe and Asia, is worse than what we see here in the US, and our current asset allocation decisions reflect that view. Now, let's turn and take a look at the earnings outlook for corporations here in the US. While the employment market and economic outlook are important for us in developing our views, ultimately what matters for you as investors in the markets is the impact that all of these forces are having on corporate earnings, as growth in earnings is the long-term driver of returns for equity market investors. At a high level, the trend that we're seeing is a decline in expectations for earnings growth for US equities, but not to recessionary levels. Earlier this year, the market was expecting close to 10% earnings growth for US companies in both 2022 and 2023. However, around June of this year, expectations for earnings growth began to moderate. The market is now expecting close to 3 to 5% earnings growth in both 2022 and 2023. While these levels are below historical averages, they suggest the market is not currently pricing in a recession, which historically has led to double-digit declines in corporate earnings. As we stand today, the S&P 500 is expected to produce close to $218 of earnings per share in 2022 and $230 of earnings per share in 2023. This would represent roughly 5% year-on-year earnings growth. Current expectations for full year 2022 S&P 500 earnings are around 5%. But looking a little more closely at each of the sectors in the US economy, there is wide dispersion across the various portions of the market. Not surprisingly, the energy sector is expected to see over 100% earnings growth in 2022, while historically high growth sectors such as technology and communication services are expected to see declines. If you were to strip out the energy sector and look at the S&P 500 X energy, we would expect to see a nominal decline in corporate earnings for 2022. Shifting to valuations, this chart shows the PE ratio for the S&P 500 over the last 10 years. The PE ratio looks at what price investors are paying for each dollar of earnings that their equity investments are generating. This is one of the most commonly used metrics for valuation of the equity markets. In general, a higher PE ratio means that stocks are more expensive, and a lower PE ratio means that stocks are cheaper. As you can see, in late 2020 and into early 2021, PE ratios in the equity markets were elevated at over 20 times earnings. Throughout 2022, as prices declined and earnings continued to expand at a modest rate, we have seen PE ratios decline. Currently, they sit right around 17 to 18 times earnings, which is in line with historical averages. Looking back throughout the last 10 years, we have seen PE ratios bottom out between 13 and 15 times earnings in times of market stress, suggesting that there could be more potential downside risk if the economy were to enter a recession in the coming year. This chart does a great job of breaking down the market declines in terms of two data points that we have just discussed: earnings growth and valuations. In maroon, you can see the price decline on the S&P 500 throughout the course of the year. For 2022, the index is down just over 19%. However, at the same time, in gold you can see that the earnings on the S&P 500 have continued to grow by about 3.1%. That means that over 100% of the decline in equities is due to multiple contraction, or declining valuations. PE ratios on the S&P 500 declined by almost 23% in 2022. We might ask, if earnings continue to grow, then why are valuations decreasing by so much? The answer to that goes back to inflation and the Fed. Given the uncertainty around inflation and how much more attractive bonds are getting as their yields go higher, investors do not want to pay as much for each dollar of earnings in the equity market, and so we are seeing a significant decline in equity market valuations. On my last two slides here, I'm going to talk a little bit about the impact that inflation is having on equity market valuations. On this chart, on the bottom x-axis, we break up different market environments in history based on their level of inflation. And on the left y-axis, we look at the PE ratio valuation of the equity markets during those times. As you can see, lower inflation has historically been correlated with higher equity market valuations, and vice versa. As inflation rises, investors have not been willing to pay as high of a multiple on their equity investments. Currently, we are in an environment where inflation is between 6 and 8%. As you can see, PE multiples have historically been between 11 and 12 times earnings during those environments. However, today we are seeing PE multiples closer to 17 to 18 times earnings. Why are multiples able to stay elevated near historical averages even though we are in this high inflation environment? Two reasons. The first is that given the strong labor market and consumer savings, the market continues to expect earnings growth for U.S. corporations. And second, despite the elevated inflation that we have seen this year, investors continue to believe that inflation will come back down towards historical averages as we move through 2023. Just as we spoke about with the leading economic indicators, the trajectory and trend of the data is more important than the current level. The same is true with inflation. This chart shows inflation expectations over the next 5 years throughout time. While this number has moved up and down by a few percentage points over the last 2 years, this index hasn't moved nearly as high as the spot level of inflation, which peaked out at just over 9% in the middle of this year. And currently, the interest rate markets are projecting that inflation will average just 2.33% over the next 5 years. Economists would say that this indicates that inflation expectations are anchored, and the market believes that the Fed is going to be able to bring inflation back down towards its 2% target in the coming years. It is very important for the markets that inflation expectations remain anchored, as corporate America and investors will both invest with more conviction and support market valuations if they believe that they have a firm handle on where inflation will go in the future.
This is Ross Bramwell again, and I'll wrap it up with the final two slides. Here we have, looking at history, bear markets typically last more than 1 year. We hit the S&P 500 low point this fall, so the downtrend lasted 9 months. But we've been very choppy since then, and we expect volatility to remain high until we have some clarity from the Fed on their endgame, which may not be until their March or May meeting even. Moving from a bear market to a bull market will depend on if the Fed can be successful in threading the needle on bringing down inflation without unemployment reaching recessionary levels. But the good news is that everything that we have talked about is already baked into a long-term financial plan. Volatility and risk are assumptions that go into determining an asset allocation. While there has been nowhere to hide for 2022 within stocks and bonds, we know that over time, long-term investors have been successful when they stay within their financial plan, even when risks are elevated. This chart just emphasizes that point. It shows the volatility of markets over a 1-year, 5-year, 10-year, and 20-year time horizon. Negative returns, the red bars, do happen more often within 1 year, but as you increase that time period, those number of negative instances decrease. We still believe that diversification, rebalancing our allocations, overall sticking to a financial plan will ultimately give clients the peace of mind and outcomes they desire. Again, we thank you for watching this presentation with us as we begin this year. We wish you and your family the best for 2023, and we are thankful for the confidence that you have in us to be able to work with you and your family. If you have any questions that you would like to discuss further, please reach out to a member of your service team. Thanks again.